So this brings us to a sort of summary of Warren Buffett's approach, and particularly his approach to value investing. We've come effectively to a fork in the road, and you are standing at that fork and you have to decide which way you're going to go. To our left lies modern portfolio theory and, at the moment, market orthodoxy. But to our right is the road mapped out for us by Benjamin Graham and Warren Buffett. The modern term for this investment approach is value or focus investing. It is, as to modern portfolio theory, as black is to white, as chalk is to cheese. Investors are not rational profit maximisers. Like Mr. Market, they're emotional and irrational. They suffer from periodic episodes of fear and greed. The market is not efficient. It veers from bull markets to bear markets, from booms and bubbles to busts. Think about it. At a time today when everybody thinks fortunes are to be made trading on the Robin Hood app, where do you think we are? Market price tells us nothing about risk, particularly about business risk. The beta, a neat mathematical calculation, tells us only about how share prices move in relation to the market. As it gyrates and swings, it tells us nothing about the changes in the underlying risk characteristics of a business, certainly not on a day-to-day or quarter-to-quarter basis. Risk is about the economic performance of businesses. We need to understand how a business works, how it has performed and is likely to perform, and the capital allocation strategies of its management, rather than just take a shortcut and use a beta. The optimal portfolio is a focus group of carefully analysed and selected stocks with significant positions taken to maximise returns on high probability events, the high probability events being the continued growth and profitability of the business. While a highly diversified portfolio of many stocks may enable you to get close to matching the market performance, it will always trend towards the average, and there will be little chance of significant outperformance. Do not underestimate the degree to which modern portfolio theory is embedded into modern finance. You have only to read the financial press to see it is the dominant approach to which most of the industry owe their livelihoods. I leave the last word to Benjamin Graham. He says, "You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right." The main takeaway from this examination of modern portfolio theory is that there are no shortcuts. We must learn how to evaluate businesses for ourselves whilst keeping within our own circle of competence. This is the critical lesson to learn as you delve more deeply into value investment and the valuation of intrinsic value. So as you've seen, what you need to understand is that modern portfolio theory makes it all look very simple, but actually what you do need to do is go and really understand how businesses make money and how you can calculate their intrinsic value yourself, completely separate from what the market is doing and what the share price is apparently telling you.